Hello, Conrad. Good to see you. 2023 is over. It's reporting day. We're closing the books. Let's start with a look at our Q4 results. Where do we stand here, Conrad?
Yeah, hello, Kai. Good to be with you. We finished the year relatively strong. If you look at our Q4 sales versus our third quarter sales, we saw a sequential increase in local currency organic growth of 4%. If you compare the year on year, we were down 10%, however, but this is a reflection of the very strong sales in Catalyst in the prior year from our new plant in China.
I see. Yeah, but still sales are down, like you said, which means that margin management is even more important and also a bit more challenging. How have we done so far here?
Yeah, if you look at our margin management, we finished the year in EBITDA margins underlying at 14.9% in the fourth quarter versus 15.3% in the prior year. So that is actually quite a resilient performance in our underlying business. The reported number, 10% EBITDA in Q4, does reflect the one-offs, the closure cost, some restructuring related to our announcement to close our bioethanol plant in Romania.
I see. And what does this all mean for the full year results last year?
Yeah, for the full year results last year, our revenue minus 7%, organic sales in local currency. Here, I'm actually quite pleased with that number, especially if you look at it, that it reflects a 7% decline in volumes, but we were able to hold our prices stable in a deflationary environment where we saw clearly our raw materials coming down. Overall EBITDA margin underlying for the year 13.9% versus 14.6% in the prior year.
So we don't only have financial KPI in our targets, but also non-financial KPI. What can you report here in terms of progress last year?
Yeah, if you look at our carbon reduction targets, Scope 1, Scope 2 emissions down 13%, Scope 3 upstream down 12%. So much more down than our revenues were down. Our revenues were down 7%. So what you see is that the carbon intensity, the carbon footprint per ton of products produced came down significantly. So we didn't only benefit from lower volumes, but we clearly had a lot of activities to bring down the carbon intensity of the company. One nice example I would like to call out here, that is the Bontepally site in India, which is now the first carbon neutral site in Clariant. The site successfully shifted from coal to fire our boiler house on the site to biomass, and with that became carbon neutral. So a big congratulations to our local team in India for this achievement.
Yeah, absolutely. That's a very good example. So talking about non-financials, Conrad, last year we introduced a new operating model, and we said we also want to measure the success here, looking at customer satisfaction, looking at safety developments, and also at employee engagement. What do the recent numbers tell us here?
Yeah, of the metrics that you mentioned, yeah, of course, safety is our most important metric, and it's more important, obviously, than our financial metrics even. I'm extremely pleased with our safety improvements that we've achieved in the company last year. If you look at our DART rates, they have come down by 46%. The total number of DART injuries reduced from 47 to 26 for the year. It is our objective to have 0 injuries. But with this current DART rate, we have placed the company in the top quartile of our industry. I think it's a huge compliment to the entire company. Safety is a number one priority for all of us. And a reduction in the DART rates by 46% is something I had never seen in my career, almost 30 years in the chemical industry. So a big compliment and a big thank you to all of our teams here. Yeah, you mentioned positive results from our new operating model. I think what is a nice indicator is the step change improvement in employee engagement. So we measure the NPS score for our employee engagement, and we went up 20 points, which is a very substantial increase, reflecting a very substantial increase in our employee engagement. So I think that is definitely, some of that is attributable to the new operating model. There's higher inclusion rates. There's much more empowerment perceived in our roles. There's a more outside focus in the company. And in the end, I think the report back is we have created more meaningful jobs. Theory suggests that employee engagement results are not only related to improved safety scores, but they're also having a strong correlation with customer satisfaction. And interesting enough, we saw that as well. So I'm very pleased that we also could report an increase in our customer NPS from 42 to 45 points. And that places us 8 points above the industry average in chemicals and gas industry. So we're also very pleased with that.
That's very impressive, especially since this seems to be against the trend, whereas we see in other companies in difficult times, typically engagement goes down. Conrad, let me also ask you about another thing that may also be related to engagement, innovation, especially in times of low demand. It's really important that you have a strong pipeline, that you have some innovations which generate sales. What do you see here as the latest developments?
Yeah, innovation remains a very high priority for the company. It is through our innovation that we consistently deliver sustainability solutions to our customers. We're spending more than 3% of sales on R&D, more than most of our peers, and we'll continue to have that strong commitment. What I'm very pleased with is that in an environment where there was weak demand, last year we delivered a record year in terms of our new innovation sales. We're tracking that internally. And we've talked a lot about the success of our Catofin new products. But for example, being specified as the unique supplier to the first e-methanol plant in Europe, that was a nice milestone for our catalyst team. And we see that also with our sort of more conventional catalyst. If you look at, for instance, ammonia production, we clearly have the most selective and the most robust catalyst right now. And that's part of the share gains that we saw in some of these segments that we achieved.
So against the background of all these good news, Conrad, may I assume that you're optimistic about the outlook for 2024 then?
Yeah, we are cautiously optimistic with our outlook. We guide for low single-digit revenue growth this year and an improvement in our profitability to an EBITDA margin around 15%. Now, keep in mind that still includes a negative 45 million Swiss francs for biofuels. If you correct for that, we actually see a 16% EBITDA margin for the rest of the business.
And that would be another step towards higher margins in 2025. Nevertheless, we adapted our guidance. Could you also elaborate on that a bit?
Yeah, for 25, we are guiding for 17 to 18% EBITDA margin. What you see is that we have there the full benefit of our performance improvement programs. This is the 170 million performance improvement program that we announced. What you see there is that we have the full benefits, the full inclusion in the results of Lucas Meyer, and including some synergy capture on revenue. What you also see is that the negative drag from biofuels is out of the results, but also a market recovery. So if you look right now at the projections for 2025, it is actually a pickup in chemical demand, where we will see a return for durable goods demand, which is projected, and that obviously will be beneficiary for our business. We're targeting a 3 to 5% growth in 2025.
Yeah, that should make us confident. And Conrad, last question, by when would you expect us to reach the midterm targets that we communicated in 2021?
Yeah, if you look at our midterm targets, we are very confident that we are on track to deliver these as trading conditions normalize. And I think you should look at a 2-3 year time frame from now for that to happen. But I think if you look high level, Last year, GDP 2.7%, slowing down this year to 2.4%, and then picking up in 25 to 2.6%. These are some of the forecasts from Oxford Economics. What is important to realize is last year this was still largely services GDP. This year you will see this shifting back to industrial GDP. And actually next year the projections are for durable goods to return, and we should see then a solid demand returning for chemicals.
So that means last year you told me people go to restaurants, they travel a lot, they don't buy computers. Now they go back, buy computers, buy durable goods, new cars, these kind of things that would benefit us, right?
If you look very specifically at our business segments, let me quickly get through them. So Catalyst, this year we see a bit of a slowdown because we had a strong new build year last year, and there is a time lag before that results into refill business. If you look at our chemical business this year, clearly a recovery because the destocking effect will be out of the numbers this year, and we will see positive impact coming in from Lucas Meyer. If you look at our adsorbents and additive business, we will see continued strong growth for purification of renewable fuel. But for additives, we will see a return in demand. Last year, if you look at consumer electronics, cell phones still down low single digits, laptop down low double digits. This year, the projections are for a 5% growth in consumer electronics. If you look at electric vehicles, last year, strong growth of 36%. This year, projections for, again, strong growth, a bit lower, but 22%. The big change here is that the growth all came last year from the Chinese OEMs. We're well positioned now to capture that growth moving forward with our new additive plant that came on stream in October last year.
Yeah, thanks for these insights. And Conrad, I'm happy to see that you started the year with confidence. So I wish you lots of success, all of us, and all the best.
Thank you, Kai.